Everyone, welcome to today's episode of our 7 Investing podcast. I'm 7 Investing founder and CEO Simon Erickson, and it is our mission to empower you to invest in your future. I am very, very excited to welcome my guest today because there's a lot going on in the macroeconomic picture. Are you talking about rising interest rates, inflation, or the zillion other things to consider? There's a lot for investors to make sense of right now. It's very exciting for me to welcome 2 brothers, Vishal and Rishi Daryanani, who are located in Panama. Have got a really, really good, insightful view of the global macroeconomic picture and what it will mean for stock market investors. Vishal and Rishi, I'm really excited to have you on the program. Thanks for being a part of our 7 Investing podcast.
Thank you for having us.
Yeah, thank you, Simon.
Guys, I'm pretty excited too because you've done a ton of prep for this podcast, which is going to make my job even easier. It even includes a formal presentation that we can kind of go through, a slideshow that you prepared for this, and then we'll come back up for air and have a conversation to split it up a little bit. But if you would like to go ahead and get started, why not? Let's fire up the PowerPoint.
Yep, absolutely. So thank you so much for that warm introduction. We have a couple of slides prepared that I'll pull up right now. And for everyone listening on audio only, don't worry, we will go into a lot of detail on what we're looking at here.
Absolutely.
I'll just pull this up.
Make sure to watch it on video on YouTube too, so you can see the awesome backgrounds in Vishal and Rishi's screens right now.
All right, cool. Well, let's get started. So we figured it would be a good idea to kind of give, 10,000 foot overview of what's going on. And really take a step back and see what the markets have done since the great financial crisis of 2008. We figured this would be important because monetary policy really changed after 2008, and for reasons that we're going to discuss right now. But if we look at March 2009, that's when the great financial crisis bottomed. And it was a really scary moment for a lot of investors. But from that moment on, we had what was known as the Great Expansion. So we had a 131-month bull run. It's the longest bull run in history, starting in March 2009 and then ending in February 2020. So right before the COVID crash. And the reason we're focusing in on this is what's really interesting is if you look at that March 2009 date, what happened? How did the market bottom? So interest rates were set to 0. So the federal funds rate or short-term interest rates were set to 0, but the Fed needed a more accommodative monetary policy tool. So they implemented what's called quantitative easing. And this was the first time that the Federal Reserve had ever done QE. Other countries like Japan had done it before for prior decades, but this was the first time the Fed had ever done QE. And basically all this is, in a very general sense, is that the Federal Reserve would buy longer dated assets or debt securities. So they would buy long dated treasuries, they would buy agency mortgage-backed securities. And the idea is that they would be bidding up the prices for these debt securities. And in turn, the yields would go down because naturally there's an inverse relationship between price and with the yields. So they would be driving down the yields of these long-term debt securities. So what's interesting is that although 2009 was the first time that we'd ever seen the Federal Reserve do quantitative easing, they actually did it 3 times between 2009 and 2014. However, the largest round of quantitative easing was done in March 2020. So that's the bottom of the really scary COVID crash that we had. The Federal Reserve stepped in and they started their largest long-term asset purchasing program. And if you look on screen, we've got a chart of both the S&P 500 and then a chart of the Federal Reserve's balance sheet. So whenever the Federal Reserve does quantitative easing, the balance sheet grows. And you'll notice that the bottom of the COVID crash in March 2020 lines up very perfectly with the big spike in the Federal Reserve's balance sheet. So basically the point we're trying to illustrate here is that during this period of 131 months, naturally markets went up because, companies became more innovative, companies grew, we overall became more productive, but also monetary policy became much more accommodative and much easier than it was in prior years. And that's something that is going to be very relevant for the conversation moving forward. So I think we can go on to the next slide and kind of look a little closer into how QE affected long-term rates like mortgage rates and Treasury yields.
So thank you, Vishal, for that introduction. Wonderful explanation of what's been going on for the past 10 years. As Vishal previously mentioned, QE4 was the largest QE session that the Fed has ever conducted. To explain further, by March, at the beginning, they injected about $700 billion to buy mortgage-backed securities and treasuries. Then after that, by June 2020, they engaged in a more gradual structure where they were pumping in $120 billion to buy $80 billion worth of long-dated treasuries and $40 billion worth of mortgage-backed securities. So the result of all these purchases, as we mentioned earlier, was that once the Fed pumped money to buy these assets, the yields dropped, meaning that before the 2020 crash and any effects from COVID, for example, a 30-year fixed mortgage was more close to around 4%, as we can see in the chart over here that we put up. But after QE program, that 30-year fixed mortgage dropped to 2.65%. Same with the 10-year Treasury yield. It was closer to around 2%. But then after QE, that yield dropped to a low of 0.52% throughout the program. What does this say? It literally means that the cost of borrowing a house has dropped significantly, and overall borrowing in general, the cost for that has gone down because rates got really low. So as a result, what happened in the end? Asset prices in general just went up. This is why we saw a boom in the housing market throughout as a response to whatever happened in COVID. And this is why we saw S&P 500 go through a complete V-shaped recovery and go through one of its sharpest rallies ever in the year 2020 and throughout 2022 even. So it's a result of this lowering of rates, this easier availability of liquidity, more accommodative monetary policy and financial system that made all these asset run-ups possible. So as a result, we can see why these asset prices went up. Some people argue that this behavior was inflationary. We would say that this was partly inflationary because because of one simple phenomena known as the wealth effect. Whenever these asset prices go up, what tends to happen is that the general population, whoever owns these assets, stocks or houses, tend to feel the effects of wealth effect. So this means that they gain increased consumer confidence. They become more bold in their spending. They're fine with making more exuberant purchases. Like for example, if you've seen like a Mercedes with a Bitcoin license plate, like you've seen a lot of those during QE. People have become more bold to spend. Since the price of their houses went up, they could post it as a collateral to borrow even more money at lower rates. And on top of that, all these assets provided like a source of passive income, form of dividends or interest or rent. So this is a time in which QE did provide some form of stimulus. It did inflate prices up because it made people want to spend more, but it isn't necessarily the only cause of inflation. That's a very common misconception. QE did contribute to some inflation, but there were other factors that were more direct. We have to make it a point to say that QE is mainly limited to the Fed using reserves that stay in the banking system instead of actually going directly into consumers' deposits. So that's why we have to mention some other factors that led to inflation, not only QE. And Vishal will go more into those in the next slide.
All right, so when we're thinking about what caused inflation in 2020 and 2021, sure, quantitative easing had a role in that due to the wealth effects and some other reasons, but two of the very important factors are compromised supply chains and then fiscal spending. So as far as compromised supply chains, at the height of lockdowns, I'm sure many people know that ports were congested, factories and big manufacturing hubs were not operating at full capacity because of all the restrictions. Our family works in the retail electronics space, so we felt this personally. We saw the price of freight go up immensely during this time. So products in general just ended up costing a lot more even here in Panama. And that basically happened all over the world as you had limited supply. So we had underinvestment in certain commodities. We had underinvestment in certain supply chains. We had underinvestment in energy transport systems. And so all that led to big decreases in supply. But the other factor that was really important was the very large amounts of fiscal spending or government spending. So on screen, we have a chart of M2 money supply. And prior to COVID, the total money supply was about 15.5 trillion. And right now it's about 21.75 trillion. So it shot up completely. And that wasn't due to quantitative easing. That was due to mostly large amounts of fiscal spending. On screen, we also have a headline which says COVID relief bigger than World War II budget. Sounds right. So essentially what that's saying is that the fiscal spending as a percent of GDP for COVID relief was actually larger than that of World War II. So that came in the form of stimulus checks, helicopter money, unfunded loan cuts. Basically, all that excessive spending was what gave, put more money in the system and gave consumers the ability to demand more whilst supply was constrained. And hence we saw an increase in CPI, which Rishi's going to go over just now.
All right, so as Vishal previously mentioned, there was large sum of fiscal spending. A lot of this came in the form of helicopter money, where the government would directly give stimulus checks to the people. So as a result, a lot of this pent-up spending potential kind of stayed in check while lockdown measures were still in place, meaning throughout 2020 and 2021, we didn't see like such high levels of CPI prints. It was only once we started seeing this trend where the reopening took place around March, April, that we started seeing CPI increase. Because I mean, what do you expect? You lock a bunch of people up. They're saving up a ton of money. They have nothing to spend it on. Then they're collecting additional stimulus checks. So then by the time you reopen the economy and let people out, you'll see this drastic change in CPI. It went from 2.6 in March and hopped over 4% in April 2021. And this is a very historically high number. I mean, I don't think we've had prints this high for a long time, for decades. So in that sense, we can see how reopening the economy and the stimulus checks that were pent up until March allowed that spending to just come out in April. And then it led to higher CPI prints as a result. Add that to with the fact that supply chains were just simply not ready for the sudden surge of demand, this reaction to stepping out. And we see supply pressure leading to price pressure up, and then the additional demand also driving prices up. And we've noted that it's throughout March and April where that trend changed and that breakout happened in CPI prints. Moving on.
Yeah. So one thing we wanted to note that was really important was, so in 2020 and 2021, we saw inflation in both asset prices and then also in the real economy, as Rishi mentioned, that really picked up more so in 2021. If you recall to 2021, Jerome Powell and many of the members of the Fed often referred to inflation as transitory. That was like the big buzzword in 2021, essentially signaling that they believed inflation was going to peak relatively, in that year and then come down at a certain point. But as prints kept rising, CPI prints kept rising, they weren't falling. It eventually turned Jerome Powell to have to pivot into a much more hawkish stance. So on November 30th, 2021, he said that it was probably time to retire the word transitory in reference to inflation. Now, this was a really big moment, and honestly, it was the start of the turn in financial markets. Because when he said this, it told us a lot of things. It told us that financial conditions were going to tighten. It told us that interest rates were going to rise, and that the Fed was committed to fighting inflation, that inflation was enemy number one. And due to this, the Fed basically guided us and told us what was going to happen in the future. So to illustrate what that means, I'll go to the next slide, which shows the Goldman Sachs financial conditions. So one phrase that was used a lot by the Fed was financial conditions are going to tighten. Now, that term financial conditions has a very specific meaning. It's not just some random term that they use. It actually has a very specific meaning. And to know what that means, we can look at various financial conditions indices. One of the most popular ones is the Goldman Sachs Financial Conditions Index. So if we break that down into the various components, well, what does that include? What leads to a tightening of this index? One is wider credit spreads. Two is the foreign exchange rate, so a stronger dollar. Three is higher risk-free rates. And four is lower equity valuations. We're going to go through each of those components in a little bit more detail, but the idea is that the Fed told us financial conditions were going to tighten. If you break that down into the various components, we can know what that means. And sure enough, all these four things happened. All these four components got tighter. And on the visual here, we have the actual chart of the Goldman Sachs Financial Conditions Index. Prior to Jerome Powell's speech in November 30th, the index was at around 97. It's now closer to 100. That doesn't seem like a massive jump, but it really is. If you look at the picture, you'll see how sharp that jump is. And also in historical terms, the value we're at right now isn't very restrictive as far as historical terms, but it's that rate of change, that pace that we went from very loose and easy policy to much tighter policy that's quite impactful. So now we're going to go through and just break down each one of the components.
First of all, this is the most obvious and relevant component, lower equity valuations. It's very apparent in this chart. You can see in S&P 500 year to date, we've been down roughly 20%. So that's one check mark in the four financial conditions index to demonstrate that there's tightening. So there's a check mark there. The asset values have gone down. Furthermore, we're going to go over wider credit spreads. In this scenario, for anyone in the audience who isn't familiar what credit spreads are, it's the difference between yields of the risk-free rate, which tends to be treasuries, and riskier assets like high-yield bonds, and they have to be at the same maturity to make the comparison. So in this scenario, high-yield bond spreads have shot up. This means that the high-yield bonds, which are in other words known as junk bonds, or bonds that deal with corporations that have a credit rating of BB or lower, that yield has gone up. That means that investors are looking for a higher return to be willing to take on this debt. Before Powell announced that he was going to go hawkish in November of last year, the high-yield bond spread was at 3.02%, difference between that and the Treasury. But then we fast forward to today. After Powell has switched his tone to hawkish and more tightening has been conducted, that high yield bond spread has jumped up to 5.36%, meaning now that these assets are viewed as more risky. Investors are going to require a higher yield to be willing to take on that loan in their balance sheets. So this indicates that the conditions are tightening. Money is less available, and investors are less willing to offer debt to these corporations. And moving on, if we could see the next slide, so we can see the investment grade bond spread. This means that these are bonds related to corporations with a better credit rating, BBB or higher. This includes popular companies like Apple or Microsoft that are deemed more creditworthy and safer to invest in. Even those spreads weren't spared from this financial tightening condition. Before Powell's announcement, the spreads were at 0.86%, meaning that investors need 0.86% more return than the risk-free rate to be willing to invest in this asset. That value jumped up to 1.57% if we fast forward to this month, after Jerome Powell tightened. So even with the most creditworthy corporate bonds, we're still seeing a widening in spreads, and that checks off on the second condition on verifying on how tight the financial conditions are. We can see that the credit spreads are in fact widening from these charts.
Third, we have the foreign exchange rate. So the US dollar, everyone knows, has gone in much stronger throughout the year. On the screen, we have DXY, which is the US dollar index. At the beginning of the year, the reading on that was about 96, and now we're at about 108. So that's a pretty significant jump for the US dollar index. And that's due to higher rates and just tightening conditions overall. A lot of investors are looking for safety in the US dollar, hence the run up in this index. And the strength of the dollar is also seen in other exchange rates. So for example, the euro to US dollar is now at parity. So that's a one-to-one exchange rate. A big part of that is the euro becoming weaker from their own policies, but then also the US dollar becoming so much stronger. So to see this one-to-one parity is honestly quite surprising, not something many of us expected to see for a long time. And that's also something we were able to expect. We were able to expect the dollar to become stronger because the Fed was telling us financial conditions were going to tighten. And lastly, the fourth component of financial conditions is higher risk-free rates. So no surprise here, the federal funds rate was at a range of 0 to 0.25%. Up until March of this year. March is when we had the first rate hike of 25 basis points. And then more recently, we've had a 75-point basis hike at the June meeting. That was the largest rate hike since 1994. And that brought us up to a target Fed funds rate of 1.5% to 1.75%. So again, we knew rates were going to go up. The Fed told us rates were going to go up, and they did. They have gone up at a faster pace than guided. And that's something we're going to discuss a little bit more later. But again, just goes to show the Fed guides the market and the market responds accordingly. And this is a clear indication of that is rates all across the yield curve. So all risk-free rates have gone up. We've got a chart here which shows the yield curve, which essentially plots the yields of various maturities. So it'll plot everywhere from the 1-month Treasury bill to the 30-year Treasury bond. And rates across the entire curve have gone up since 2021 and 2020. And so this is just also signals a tightening of financial conditions because the cost of borrowing has gone up across all maturities.
Furthermore, we can't really ignore the effect of one important event that happened this year, which is the war in Ukraine between Russia and Ukraine. It's definitely an impactful event because war is a highly destabilizing event, especially war between two fully formed nation states. One factor that we definitely have to take into consideration is the share of exports for very crucial commodities and food products that come from this region, from the two countries, even Belarus. To mention some particular examples, we have natural gas, palladium, and other fertilizers, as well as food products like wheat and barley. Large chunks of those products come from this area. If we look at the percentage of the share of global exports for palladium, for example, over more than 20% of all the exported palladium, which is a fertilizer component, comes from Russia. And now that that product has been cut off essentially from the West, that's going to affect markets in that department too. The price of these commodities are going to go up. Wheat, for example, Ukraine and Russia provides more than 20% of the exported wheat in the world. Now that the war has completely destabilized the region, the supply of this product has been completely cut off. So that's definitely going to put a strain on the supply side when it comes to inflation. And we can't ignore the effect of this war as it is destabilizing the region and also affecting global trade and the ability for countries to acquire their basic food and energy needs. As we can see in this chart, which points out every single export that's crucial from the region, it's going to definitely have an impact on prices in the future, as long as this conflict keeps going on. Moving on, we've also had the unfortunate luck of dealing with zero COVID policy in China. Although the situation has improved now in June, July, back in May, we've had issues with ships just being congested in major shipping ports in Shanghai. We can see in this chart that in May that there's peak congestion in the ports. This put a heavy strain on international trade in general. We see this also affecting US CPI prints because a lot of consumer discretionary products come from China. They export all the discretionary goods to the United States. So because of this event, because of political tension and tension caused by COVID measures, this would drive the price of discretionary goods up.
So the reason we brought up both of those events is that's made inflation more elevated and even stickier than anticipated. So the recent reading on inflation was 8.6%, and those are numbers we haven't seen since the late 1970s and early 1980s. And just to kind of give a small little history lesson of the time, the United States went through a very inflationary period from 1965 to 1982, known as the Great Inflation. And in that time, inflation was uncontrollable and so was unemployment. And this was a product of excessive fiscal spending, easy monetary policy, and then also supply shocks. So there were 2 oil embargoes that happened in that time period. Some of those events sound pretty similar right now. I mean, there are definitely key differences, so we don't want to make it sound as though it's a direct comparison to the 70s, although that comparison is often used. But the way the Great Inflation period ended was former Fed Chairman Paul Volcker essentially constrained the rate of money supply growth to the point that interest rates got up all the way to 20%, which is just something unfathomable because we're right now at a range of 1.5% to 1.75%. The key difference is, though, that in 1980, the US had a debt to GDP ratio of about 30%, but now we have a debt to GDP ratio of about 130%. So the point here is the same measures that were taken back then are not really applicable, are not really available to us right now because the system is so much more leveraged. There's what's called zombie companies, which I think about 20% of companies in the US are zombie companies, meaning that their debt servicing costs exceed the profits that they make. So when rates go up, that really harms those kinds of companies. And so this has led investors to really wonder, how much can the Fed tighten? We have so much more leverage and so much more debt. Can we really tighten as much as the Fed is guiding? And investors are betting against the Fed doing that, and for reasons we'll show in the next slide.
So the direction of the economy is highly uncertain. The Fed makes it a point in their dot plot. As we see in this chart, the Fed has their estimate of what the terminal value for the Fed funds rate is going to be. The Fed members themselves predict that by the end of 2023, we'll reach a terminal rate of 3.8%. But we're seeing a lot of market participants going against this estimate. They essentially are challenging the Fed right now. And we can see this in the bond market. When you look at Fed funds futures, they're pricing in a much lower terminal value than the actual Fed members are expecting. Right now, the bond market through Fed funds futures is pricing in a terminal value of 2.8%, as we can see in the chart. So as we can see here, there's a lot of uncertainty as to how much tightening the Fed has to do. How much tightening will they even be able to do? How strong the economy is, because there's conflicting data. Even though the Purchasing Managers Index has gone down this year, we're still seeing a strong labor market with unemployment at very low levels. So the reality is we're not really certain how tight the Fed is going to be. Not to mention that in many of Jerome Powell's speeches, he talks about the need to be nimble and to respond immediately to data. So for example, in the past 2 years, we have an example of Jerome Powell engaging in so-called pivot. Vishal will go into this in more detail.
Yep. So one of the big things people talk about right now is the Fed pivot. If and when the Fed will pivot, are they going to move into more accommodative policy? Are they going to continue tightening? And on the screen, we have a chart which basically shows the last time the Fed did quantitative tightening was in 2018. That was the first time, or maybe it started in 2017, but that was the first time they had done quantitative tightening. However, they were forced to abruptly end QT in September 2019 after a spike in repo rates. And the reason we're showing this is that this was something unexpected. This spike in repo rates was totally unexpected to the Fed. And since the financial system is so complex and we're dealing with raising interest rates, we're dealing with quantitative tightening now, we don't really know what might break next. We were recently watching an interview with Joseph Wang, who's a former senior Fed trader, and he brought up this example of this September 2019 blow up in repo rates. And what he was saying is that it's unlikely we'll see the same thing break again, but something else could very well break. So a lot of people are thinking, the Fed is going to tighten until something breaks. What that thing is going to be is uncertain. But the reason we bring it up is that it's a very real possibility that this rapid tightening could cause some kind of unintended consequence in financial system. So these are things that we're going to be watching and being aware of.
Things that we're going to be looking at. One event in particular that we're very interested in is the announcement of June CPI data. As we all know, these numbers have been printing really high. We've had 8.6% for May. It's been constantly going up. If we see prints that are higher than 8.6%, as certain spokespeople in the White House are potentially suggesting, then that could mean that we're more likely to be in a stagflationary environment, which is really bad for all financial assets in general. But we're also seeing the other side of the argument, which is related to predictions that were made by famous investor Michael Burry and predictions that Cathie Wood made as well. As we mentioned previously in April, we had a sudden surge in demand from the reopening. This triggered something known as the Bullwhip Effect. So in essence, we have customers placing large orders for goods basically. And as a response, retailers, distributors, suppliers, manufacturers reacted by over-ordering as a response to this sudden spike of goods. Now, this demand didn't last too long, but the result was that the retailers, the distributors all throughout the supply chain ordered an excess amount of inventory because they anticipated larger demand. But since that wasn't the case and this surge in demand was very short-lived, now we're dealing with excess inventory amongst all the major retailers, amongst many of the players in the supply chains. So what Cathie Wood and Michael Burry are suggesting is that CPI prints should go down because of this phenomenon. I think it is a very optimistic view of what could happen, but nonetheless, they make some compelling points. We are seeing scenarios in which major retailers like Target are adjusting their refund policies in the sense that whenever someone returns an unwanted item, they're literally letting the client keep the item as they refund the money. This suggests that they have no desire to store this extra good because they already have excess inventory, and the cost of storing that inventory will add up too much for them. So there is potential for disinflation in the form of lower prices in goods in the retail sector, but it's still too early to say, and that's why it's important to look at the next upcoming CPI print to see if all of this does play out.
Yep, and I just wanted to add one little thing to that is one of the things Jerome Powell said in the most recent FOMC presser is that they're looking for sequential declines in CPI readings. So they're really focused in on that month-over-month reading. And if this, this bullwhip effect might take some time to play out, but if it's correct, then what we might see is these big retailers having this inventory glut, too much stock compared to the demand, especially the weakening demand that we're seeing as consumers are getting weaker due to negative real income growth and reduced spending. And if that happens, retailers will have no choice really but to lower prices, and then that should be reflected in CPI. But something like that might take some time to play out. But we will be looking for those month-over-month readings for CPI. Okay. move on to the next one.
So that's one component that is important to look at within the United States. We also like to look at factors that could influence markets outside the US. One country in particular that we are deeply fascinated by is Japan. We're very interested in seeing what happens in the future with the Bank of Japan. Out of all the major central banks, they're the only one that's still dovish and engaging in more accommodative monetary policy. They're engaging in what is known as yield curve control, meaning that they're trying to maintain their government bond, particularly the 10-year Japanese government bond yield, at 0.25%. So how do they do this? They do this by buying excess amounts of Japanese government bonds by printing yen out, and then buying these bonds to drive the yield lower and drive the price up. This is necessary for the Bank of Japan, particularly because Japan has the highest debt to GDP ratio. So to them, it's crucial to maintain these yield levels at a certain limit, 0.25%, because increasing the yield for Japanese government bonds would increase the debt servicing costs, and it could be quite damaging for the Japanese government that has a lot of debt in its balance sheet. Furthermore, if we look at it in a global frame and see what effect it has on financial markets, a lot of investors do benefit from a weaker yen. Whenever the yield is capped off, and since it's low right now, investors use the yen, they borrow money in yen at a lower rate, and then they sell that yen in order to fund their purchases of US financial assets that yield a higher return. So as a result, they're able to pocket that money in return and pay back the low interest rate from borrowing that cheap yen. So this trade is called a yen carry trade. As we can see in this chart, the yen is currently weakened to levels. USD yen is currently above 130. So that means that it's a good. So that means that these conditions lead to more favorable, lead to more investors being able to do the yen carry trade. And because the yen is cheaper, they're able to do this. But what we have to keep in mind too is that there's a lot of pressure on both sides of the Bank of Japan. A weaker yen does lead to cheaper exports for Japan, making it more competitive. But there is political pressure on the other side. When you print a ton of yen to buy these Japanese government bonds, you do devalue the yen. And as we know in Japan, 60% of all the food that they consume is imported, and 90% of their energy is imported as well. So with such a large component of these basic expenses being imports, this puts a strain on the Japanese everyday citizen. If their yen gets weakened, the price of their living expenses goes up. So the Bank of Japan is essentially in a bit of catch-22. If they raise the cap on the yield, that makes their debt more expensive to service. It hurts them it can damage them in the sense that it could lead them to a debt spiral where they lose a lot of money. But if they keep that cap, it affects the regular people, the Japanese people. So as a result, there's a lot of political tension there. Furthermore, if we bring this back to the US and relate it to that, the largest foreign holders of US treasuries are Japanese investors. A rise in this cap of 0.25% could prompt a lot of these Japanese investors to sell their US assets and then go back to yen-denominated securities. So this, in essence, is a very important sector to look at, the Bank of Japan, and paying close attention to what they do in the future is important when it comes to understanding the direction of US stock market outlook. So we're going to move on and talk a bit about earnings compression, which is another thing we're going to look out for future stock market behavior. Vishal will go into more detail on this.
Yep, so this is the last slide we have for today, and it's actually the most recent thread that we've written. So Michael Burry came out with a tweet that went pretty viral recently, in which he said that he believes we're about 50% of the way through this bear market. And the reason he cited for it is he said that the current sell-off that we've seen in equities is mostly due to multiple compression, but the next leg down will be due to earnings compression. So what does that mean? So as far as multiple compression, we can look at the price to earnings ratio of the S&P 500. Essentially, this tells us what are investors willing to pay for a given amount of earnings. So like, what is the premium that investors are paying? A high multiple would signal that there is quite a bit of euphoria, that investors are willing to pay a lot. So at the height of the S&P this year on January 3rd, 2022, that was the peak of the S&P. The forward PE ratio, so the price over the forecasted earnings over the next 12 months, was 21.4 times. Now, this is a number that we haven't seen since basically the dot-com bubble. So that goes to show that valuations were very elevated. The multiple was very rich, and we hadn't seen these kinds of multiples for a long, long time. Now, by July 8th, the multiple contracted to 16.3. And this was mainly due to the price going down. So the numerator of that price to earnings multiple went down. But what's very interesting is this: if we want to figure out, okay, you know, where are earnings going to go? Are earnings going to be strong? Are they going to be weakened due to inflation and rising input costs, and weakened due to demand destruction from the recession? It's really important to know, what is that outlook for earnings? So if we look at consensus estimates for the S&P 500, the estimates are actually still very high. So for 2022, the forecast is about 10% higher than the EPS, or earnings per share, for 2021, and 2023 is about 9% higher than 2022. So the outlook is still quite optimistic and quite positive for corporate earnings. But what happens if earnings disappoint? As we mentioned, demand might be weaker due to a possible recession, and input costs are higher from inflation. If we start to see earnings, surprise negatively, and we start to see EPS estimates being revised downwards, then we're likely to see the price of the S&P go down as well. Because earnings as the denominator, if that goes down, the multiple goes up. But expecting to have a high multiple in a bear market environment, I mean, that would be pretty surprising. For context, the S&P bottomed in March 2020 at a 13 times forward PE multiple. And for the great financial crisis, it bottomed at an 8 times forward multiple. So, there is a risk of continued contraction of that multiple, but then there's also the added risk of what if earnings surprise to the downside. So we'll be looking very closely at earnings this quarter, listening to forward guidance across various sectors, because that will really give us a good idea of how, how tighter policy and how supply chain issues are actually affecting corporate earnings. So those are things we're looking at right now. I think that's all we got as far as the visuals in the presentation.
Well, first of all, guys, that was fantastic. What an incredible presentation, an incredible amount of work that you put into this. We'll make sure that we make that PowerPoint available for anyone who follows your presentation here on 7 Investing. But anyone who wants to follow these two brothers, Rishi and Vishal are both on Twitter with the Twitter alias The Notetaker, and that is at FinTwitNotes. They're always posting really, really good analysis. A lot of the charts, you've seen on theirs, on their Twitter handle as well. So please follow them along as well. But first and foremost, excellent job, guys. Great presentation.
Thank you so much.
Thank you. Thank you, Simon.
I did have a couple of questions that I wanted to ask about, that you presented here. The first and foremost is, it's always interesting to see when there is a financial crisis, to be able to have the chance to look back at everything in 2020 hindsight, right? You mentioned quite a lot of things with Paul Volcker back in the 70s and the 80s, but in more recent memory, we've kind of seen the Fed, or the government as a whole, react to external forces that kind of pushes its hands to take an action, right? It would be, in fact, this is kind of what the crisis has become known as, right? You have the 2001 dot-com crisis in response to kind of out of control internet advertising spending that caused a bubble from that. We have the housing crisis from subprime mortgages of 2008. And it's going to be interesting to see what we name this crisis or what this becomes named after, because there's just so many influences on it right now. The confluence of influences between the Fed's expanding balance sheet and the fiscal stimulus and the economic, reopening after COVID, and then the supply chain issues. There's a host of events going on, and it's almost like you have to say every time is different. But that leads me to the question of, do you think there are any comparisons to 2008 or 2001 that might give us some insight as to what Jerome Powell might do with his battle plan or his strategy going forward, depending on what we see in the June CPI numbers that get announced tomorrow? As he obviously wants to get back down to 2% inflation. Any thoughts overall on what might guide him and we can expect the Fed's action to do going forward here?
I can start off. So I think it's important to assess, what is the health of the economy right now. So Jerome Powell, every time he's spoken in the recent FOMC pressers, he's been very complimentary about the strength of the economy. He's been very complimentary about the labor market. But the economy consists of multiple parts, right? If we break it down, maybe we can break it down into four components. We can think of income, we can think of spending, we can think of production and employment. So as far as income, real income is actually negative. So the rate of growth of wages isn't matching up to inflation, and that can have a problem with consumption, right? Because people in general don't have the same purchasing power as before. So if real incomes stay negative and spending declines, then what we might see is a decrease in production. And that's kind of where the argument with Michael Burry and Cathie Wood comes into play, that these retailers have excess inventory, but maybe the demand is not matching up. So if production has to scale down, then what happens to employment? Employment eventually will come down as well. So it kind of seems like there's a bit of an order to this, where it's first incomes don't match up to inflation, which leads to reduced spending, which would lead to reduced production, which therefore would lead to reduced employment. I feel if the labor market starts to take a hit because of that, that might be something that would cause alarm bells with the Fed. But again, these kinds of things could take some time to play out. I feel like when Jerome Powell talks about the strength of the economy, a lot of it is due to that labor market, but that labor market isn't necessarily safe if that trend plays out the way that I think it might play out as.
It's very difficult because this situation's highly unique in the sense that it's been decades since we've had such a destabilizing event like a war between two nation states. So it's hard to make comparisons to 2001 to 2008 because we didn't have really this scenario where all of our supply chains were being completely compromised. And this could potentially be a permanent change in the world. We really wouldn't understand the outcome. That's how destabilizing this is. I think for the first time in decades too, the strategy of having 60% bonds to 40% stocks is also falling apart because now the correlation between these two assets are positive. So this hasn't happened in years, which indicates that we're now in a period where there's less stability. We haven't had persistent and rising inflation above for 4% in a while. So I think we're looking at really new territory at this point. Maybe what I try to do is look at Japan's era, where in the 90s, when they had a financial bubble and their housing prices went up, and the Nikkei also shot up like crazy due to accommodative policy. But it would be hard to draw parallels between 2001 and 2008, based on as far as I've looked upon it.
Yeah, and just one other thing I wanted to add was, so at the very beginning of the presentation, we noted that the bottom of the crash for the great financial crisis in 2009 was when the Fed introduced quantitative easing. Now, we did mention that quantitative easing isn't necessarily, as inflationary as most people think, but at the same time, we now have this problem with inflation. So if things do start to break in the market, will inflation get out of hand if we start to use more accommodative monetary policy, lower rates, things of that nature? We had that in the toolkit back then in 2009 because inflation wasn't as big of an issue now, but now we have this inflation problem. So it does feel like the tools are more limited now. We obviously don't want to sound super bleak, but it does feel like it is a harder environment now than back then.
Do you guys both have the assumption that there are future 75 basis point Fed funds rate increases in the future? That was kind of a big statement when he came out of the gate with such a high increase. Do you think there's more in the hopper here?
I think it's possible because so at the May meeting, I believe Jerome Powell told us that 75 basis points wasn't being actively discussed. But then, in June, that's sure enough, that's what they did. I think inflation is enemy number one, and rightfully so. One thing we did learn about the 1970s great inflation period is that one of the assumptions back then was that there was a trade-off between unemployment and inflation. So that was the Phillips curve. So essentially, the idea was that you could reduce unemployment by having a little bit of inflation. There was this kind of trade-off between the two. But what we came to find out during that period is that if you have persistent and elevated inflation, it will most likely lead to economic stagnation as well and lead to high unemployment. And one of the reasons for that is this idea of inflation expectations. So when the general populace, when the average person starts to expect high inflation in the future, it affects their habits today. They might ask for a raise today, it's called the wage price spiral. They might, ask for a raise, which would cause companies to have to increase their prices, now, which would then kind of kick off the inflationary spiral. So I think the Fed is really committed in bringing those inflation expectations down. I think that's one of the key things to look at. In fact, in the June FOMC meeting, Powell said that one of the reasons they did 75 basis points was that they saw long-term inflation expectations at elevated levels. Long-term would mean 5 to 10 years. There's many ways to measure that. There's the University of Michigan household survey. There's a survey of professional forecasters. There's market indicators like break-even rates. But what the Fed wants to see is they want to see those long-term inflation expectations at around 2%. At the time of the June FOMC meeting, I think they were over 3%. So that kind of caused, some alarm bells. Because if those expectations stay high, then obviously you have that wage price spiral problem and your actual inflation can get out of hand. Although I think lately we've seen expectations since then kind of trend a little bit lower. I think they're heading towards 2%. If those stay anchored around there, I think, maybe we won't see the 75 basis points hikes, but that is something that we're paying attention to determine that.
Just the mere fact that Powell's insisting that he doesn't want to plan any moves ahead and just look at data means that anything can happen. That's what it means to be nimble. Means he can go for anything depending on what CPI come out, what job report comes out, what happens in the financial system. So he will be quick to respond. He can turn around at any minute if he sees that there are any events that are catastrophic that come from tightening. So hopefully that doesn't happen, but the reality is that Powell will react right away to these events, and anything's on the card. A 75 basis point hike is his intention because he does want to tackle inflation, but he doesn't want to do so with causing any damage to the financial system. I believe there is a break-even Fed funds rate that kind of matches with economic output. Powell did say that he wanted to get to that level. I don't entirely remember what the number was. I think it was 2.5%. And he said after that, he would just go for small increases of 25 basis points. And I remember in that day, the stock market was rallying because they saw that as kind of like more accommodative. Like, it kind of dispelled that fear that Powell was going to raise rates to extreme levels. Because we don't want that either, since the US economy is very dependent on leverage right now. as opposed to like back in early 2000s when that debt to GDP level was lower.
It's a good point that, you don't want to break the entire system. You want to be nimble and look at what the data tells you. There certainly is a shock to the economy when you do allow rates to rise very quickly, right? We saw with this bump just a couple of months ago, it actually caused a yield curve inversion on April 1st. And in fact, I think, gentlemen, one of the first times that you and I actually spoke on Twitter was right after an interview that I had done with Peru Saxino, which we chatted about this and the implications of the yield curve inversion. It's only happened 4 times in 35 years. Both, or I should say all 4 of those times resulted in an American recession, at least in terms of the kind of generally accepted terminology of 2 consecutive quarters of negative GDP growth, right? But again, this is not terrible for investors. I still want to stay on the economic side of this, and we'll chat about investing on the second side of it. But do you have any thoughts about the yield curve inversion on April the 1st? Is that predictive of another recession for the U.S. economy that's upcoming within the next year and a half? Or is it just this time is different and we can't have a perfect analog of those 4 previous times in the last 3.5 decades?
And in fact, it's a good point. And in fact, I believe that the curve you're referring to, right, is the 2s 10s curve, the 2-year Treasury and the 10-year Treasury.
Correct. I should clarify, the 2-year Treasury was paying a higher interest rate than the 10-year Treasury. Exactly.
Yeah. And I actually believe that's inverted again just now very recently in the last couple of days, and this time even deeper than the last one. One thing that was interesting in your conversation with Puru is that he said he looks for an inversion that's persistent. So generally about 90 days. That time on April 1st was just, 1 day, and that was it. That was the inversion. So I think what will be interesting right now is seeing, is this current inversion going to last? Because we're getting it again. But it's also important to break it down. Like why is this inversion happening? We've seen the 10-year yield drop down pretty significantly. I think it was at its high, I think around 3.2, 3.3%. And now I believe it's under 3%. So that's telling us that investors are, fleeing to safety. They're buying these long-term bonds, bidding up the price, which therefore drives down the yields. And, that is a signal for a potential recession, is this flight to safety towards long bonds, something we haven't seen for a while. We saw the bond market really just get destroyed this year as yields went from sub 1% on the 10-year to over 3%. That's a really fast increase. And now it seems like I'm not sure if we've seen the top of the 10-year yield, but we have definitely seen a really sharp decline. So all I can say is, as far as whether we'll get a recession based on this indicator, I do agree with Puru that it'll be important to see if this inversion lasts a little bit longer than the last one, because the last one was only a day. It would be very telling to us to see if investors want to keep buying bonds, 10-year bonds at, under 3%, 2.9%, 2.8%, if they really are fleeing towards safety, even when equity valuations are so much more compressed. Are they still choosing to buy long-dated bonds versus buying riskier assets that have already come down a lot in valuation and price?
So based on what I've heard from the few experts I spoke to about this, they don't tend to like the Treasury yield curve as much, because it's a bit of a lagging indicator compared to other curves. I think there's there's one page on Twitter, Alfonso Pecatello. He looks at the overnight index swap curve instead, and he says that's more ahead than the Treasury curve. I think he believes that looking at that curve, when you see the 2 and the 10-year maturity for that curve invert, that tends to happen before the Treasury curve, which is a bit of lagging when compared to that asset. So I think, and from the conversations that I've had based on that, a lot of times it seems like a lot of economists can't explain why this happens, but they can just make the observation that throughout history, the yield curve has always inverted every time there's been a recession. So that's the main logic behind following the yield curve. But I do see a lot of people are trying to find other alternatives to the yield curve that's a bit more, that's a bit less lagging, like the OIS swap curve. So, I mean, there are some importances to the yield curve because everybody's looking at it. It will dictate the market behavior. But I think there can be some other better indicators to look at as well in terms of yield curves.
I've got one final question, but it's a big one. It's going to be asking you all to read into your crystal ball or read the tea leaves of what investors should expect with everything that we've talked about in this conversation. And it's going to be a little bit of a long wind up here. So maybe I can go on my monologue first for a moment, and then I'll ask you that question, which is ultimately coming. But the comments that I'd like to add is that the market does evolve based on what is going on, right? Based on what's going on in the economy, based on the actions the Fed is taking, based on the state of corporate earnings and everything else. And it's been so interesting to see in the last couple of years, as you all pointed out in your presentation, the speculation that's gone into the market, right? Whether it was the Mercedes that has the Bitcoin license plates and the speculation that's gone into cryptocurrencies, even as a lot of investors didn't even know what they were buying at the time. There was no cash flows or anything else to secure those. Meme stocks, let's not forget just a short time ago when AMC and GameStop were shooting to the moon based on, crowdsourced research on Wall Street bets. SPACs, special purpose acquisition companies, this was something that a flood of capital went into, even though a lot of these companies that were raising money either had very little or even no revenue, but had hockey stick growth projections. This was the perfect euphoric speculative storm that pulled, of course, a lot of capital into it that has been corrected quite a bit. It seems like the tone now is much more, at least from what I've seen, into hedge funds, the Ray Dalios of the world. Short selling and short interest is getting a lot more attention. Value investing is getting a lot more attention. The tone of the market is changing, certainly in response to what we've seen in the last couple of months. And the part two of my windup, for the question that I'm ultimately asking, which is, what do you guys think is due to come, is we have very reputable, very smart investors with very divergent opinions of what they think is going to happen in the next year or even the next couple of months of 2022 and 2023. You've got Ray Dalio, Bridgewater is taking a huge short bet on European stocks, ASML and others. It's about a $10 billion US short bet on a lot of companies over there. You showed that Michael Burry, from Big Short fame, is kind of expecting that there could be, like you said, an additional 50% drop in equities due to the compression in valuation multiples, and then secondly, the fundamental multiples to go from there. Kathy Wood, you showed Kathy Wood, who is kind of more of a bullish investor for a lot of her career. She's really focused on disruptive innovation, that being a deflationary force, whether that's cloud computing, lower storage costs, whatever it is, genomic sequencing costs coming down. A lot of technology pushes down the costs of things over time, which can counteract a lot of the issues that we're seeing today. And so all of this, everything that we've discussed for the last hour and a half here, and keeping in mind there are different opinions from very famous, very smart investors out there. What do you believe is in store for investors in 2022 and 2023? And also, do you believe there are pockets of the market that are better suited to handle everything, or pockets of the market that are still in for a lot of pain in the next couple of months and years?
I do see that a lot of disruptive innovation has been beaten down. You gotta look for companies that aren't dependent on the cyclicals, in the sense that they have to be secular. Based on what I'm hearing, it seems like there's a lot of opportunities in biotech stocks because they're not really affected by the seasonality of like demand or anything. They're just focused on their research and developing products that are ultimately going to help humanity in the end. So it really depends on like how much liquidity and cash flow these companies have. One important metric that I've heard is really good to assess this is the cash burn rate. You want to see how much of that cash you're going to spend every year, whether they have enough to weather the storm, which could last till 2023, end of 23 even. So I think at the end of the day, it all has to do with like observing the company's balance sheet. And then first and foremost, also seeing whether their business model is going to provide a lot of value for the world. Simon, I know that you have a lot of interest in AI. I definitely believe that like AI and machine learning has come a long way and it has a lot of potential to change the world. These are definitely some sectors in the economy I think can be useful, but you still have to be very careful with like what the cash flow situation is for these companies and how their business models get affected in a recessionary environment. One example I was thinking about was Upstart. They have a fantastic product that assesses the credit rating better than FICO scores. It's all AI based and it's worked amazingly so far. But they got destroyed this year. Like their stock went down tremendously because they were heavily affected by a higher interest rate environment. Their business was dependent on banks being willing to buy off the loans that they offered to people. Because they told investors, we're not going to hold on to loans in our balance sheet. We're going to be a small company. We're not going to get bloated. But since there weren't any banks that were willing to take on their loans since financial conditions tightened, Upstart had no choice but to load on these loans into their own balance sheet. And then that really made investors seem very wary. I mean, I think this quarter they reported 24% less revenue because they're just not able to sell off their loans in this environment. So disruptive innovation is great, but you still have to always scrutinize every company. We can't just like assign disruptive innovation as a label because all these companies are different. They offer different services. They operate differently. So you have to scrutinize how they perform financially in this environment, which isn't really friendly for business right now. There are going to be some tough times in the next few years. So it's always important to assess the company's balance sheet, see how their business is going to operate in a period of recession.
Great point, Rishi. Yep. Last word is yours, Vishal. What do you think?
Okay. Yeah, so absolutely. I think one thing that's important for investors to keep in mind is that the stock is not the company, right? I think Jeff Bezos said this after the dot-com bubble, in that Amazon stock had crashed, I think around 90%, maybe even more, but he was saying the company is doing better than ever. And I think there are probably a lot of opportunities like that in the market where, valuations are being compressed just because correlations across equities, is shooting towards one. You'll see on a red day, every company will be red. On a green day, every company will be green. And so the movements going on in actual stock prices isn't necessarily indicative of company performance. So I think that's something that investors need to be aware of. And those who really do their homework and study and can actually find value within this bloodbath will find great opportunities that may provide life-changing returns. The other thing that's important is a lot of this is cyclical, right? We've got these cycles of euphoria and these cycles of gloom, right? And a lot of that is due to credit, but in the long run, what really matters, it's productivity and it's growth, it's earnings. So I think despite market conditions and despite us being in one of those gloom periods where maybe valuations stay compressed a little bit longer, maybe they don't, that's not going to change the fact that there's actually companies out there solving real problems and growing. And I think even you had some really great research on this. Some companies were even able to benefit from the easy monetary conditions from before, like Taiwan Semiconductors, take advantage of low rates in this high rate environment. So investors really need to be prudent in finding which are those companies that are not only weathering the storm, but also had intelligent management that was able to take advantage of prior conditions and then therefore thrive currently and then have good growth outlooks. So I think this has happened before. These kinds of crashes have happened before in the dot-com bubble in 2008. And while I think a lot of companies might not make it, I think many of them that really truly do solve a problem and are growing will reward investors. So, and I think that'll always be the case. Fundamentals and earnings in the long run is what matters.
I personally love the company Stride. I'm not sure if you've heard of them, but they're an ed tech company and they're up this year about 23%. And one thing I love about that company is their overhead is like practically non-existent because they do a lot of virtual learning. and their expenses consist of like contracts with their teachers. So the CEO in his earnings call himself said that they would be able to manage this recessionary period well because their costs are not that high, and their mission too is like amazing. Like whatever they're trying to achieve, trying to revolutionize education through technology, seems to be working out for them. Their price to sales is practically 1, and they're still performing really well year to date in the market. So that's one company I've looked at, the EdTech space, where costs are low. They're not dependent on cyclicals. They won't get affected too much. They don't need to borrow as much. And yeah, that's one area I'd look at. But there are opportunities, 100%. Like you can't let fear keep your eyes closed and then keep you from observing, scrutinizing what can actually be valuable in the market.
Well, this was fantastic. Once again, Vishal and Rishi Daryanani, the two Panamanian brothers. You can follow them on Twitter, the Notetaker, that is at FinTwitNotes, for anyone who wants to follow along. This was a great conversation, gentlemen. We'll have to have you back on again for the 7 Investing podcast. I really appreciate you both being a part of the show.
Thank you, Simon. Honestly, that was a lot of fun. Appreciate it.
Really
thanks
happy
everybody
to be
for tuning
here.
in. Oh yeah, absolutely. Thanks Rishi. Thanks Vishal. Thanks everyone for tuning into this episode of our 7 Investing podcast. We are here to empower you to invest in your future. We are 7 Investing.
Take care.